Welcome to a short video calculating current yield or interest yield on purchase of a bond. Now, since no fancy math is required, I will not be using a financial calculator, just Excel. Now, here's a quick review on what a bond is. A bond represents debt. In addition, it's part of a firm's capital structure. The other two parts are equity, common, and preferred. However, many companies do not choose to issue preferred, therefore their capital structure comprises of only common equity and debt. Now, the cost to a firm to issue bonds is the interest expense minus the interest as tax deductions. In this case, it is 10%. Now, I could multiply it by 1 minus the tax rate to determine its true cost. However, I will not do that here. Now, bonds have an issue date and a maturity date in which the face value equals $1,000. Bonds have an interest expense or fixed payment, sometimes called coupon payment. In this case, it is 10%. Now, 10% of $1,000 is $100. However, most bonds pay semi-annually, therefore the payment would be $50 and be made twice a year. Now, let's imagine this line here as $1,000. The most difficult concept to understand is that a bond fluctuates above and below the $1,000 face value between the issue date and the maturity dates, depending on the current rates represented by this red squiggly line. Now let's look at this picture. Here's our fictitious $1,000 line at 10%. If the current rate goes below this outstanding bonds rate, it trades at a premium. If the current rate goes above this outstanding bond current coupon rate, this bond trades at a discount from face value. Finally, one last point before I calculate the current rate for both of these bonds. Bonds trade at a percentage of face value. At this bond here, to actually be listed as 120.00, stating that it's 120% of face value. Therefore, 120% of 1,000 is $1,200. Now let's go ahead and calculate the current rates for both of these securities. The one that's here at the premium and the one that's here that's the discount. The calculation is quite simple. It's nothing more than the annual payment divided by the current price. So I've already calculated it for us on this one here. So if we look up at the top here on this formula, we'll see annual price of $100 divided by the $1,200 gives us a current rate of 8.33. And yes, it is trading at a premium and the current rate is below the 10%. The second one is here, and we see that the $100 payment is divided by the discounted $900 bond, which tells me that the current rate is greater than 10%. Therefore, it is trading at a discount. Finally, one last point. Current rates are not the rate of return for investors or the rate of return that an investor would receive. This is the yield to maturity and yield to call, and I'll calculate that in another video.